So recently I've been going through Treasury data, Federal Reserve balance sheet reports, and coverage from outlets like Reuters, Bloomberg, and the Wall Street Journal. And the more I looked, the clear one thing became the United States doesn't just have a debt problem, it has a buyer problem. And in the next short window of time, the US government needs to refinance roughly $9 trillion in existing debt while adding another $2 trillion in new borrowing just to keep operation running. And that's $11 trillion that must find buyers. In a world where rates are higher, foreign demand is falling, and the Federal Reserve is already stressed out. And this video is not about panic, it's not about doom, it's about asking one simple, unavoidable question. Who is actually going to buy all this debt? Because when you follow the data instead of the headlines, the answer becomes uncomfortable very quickly. So what does $11 trillion actually means? So let's slow this down because numbers this large stop feeling real. So the US government finances itself by issuing Treasury securities, Treasury bills short term, Treasury notes that is medium term debt, and Treasury bonds that is long term debt. So when people say the debt is $34 trillion, that number alone doesn't tell you the real risk. The real risk is maturity. A massive portion of US debt does not mature decades from now. It matures soon. And according to US Treasury data, roughly $9 trillion of existing debt needs to be rolled over, meaning refinanced. On top of that, current deficit projection show another $2 trillion in new issuance. So this isn't optional borrowing, this isn't growth spending, this is maintenance borrowing. It's like a household refinancing old credit cards while opening new ones just to pay the bills, and refinancing at much higher interest rates than before. So why rolling over debt is harder now? So for years refinancing US debt was easy. Why? Because interest rates were near zero. From 2009 to 2021, the US government lived in a world where borrowing was cheap, demand for treasuries was massive, and central banks choked up supply. But that world no longer exists. Today, rates are 4 to 5% instead of near zero. Bond prices fall when yield rise. Long duration debt is far less attractive, and this changes everything. Every percentage point increase in rates massively increases interest expense, deficit pressure, and future borrowing needs. In other words, the more expensive debt, the more debt is required just to service existing obligations. And that's not a theory, that's arithmetic. Foreign buyers, the big shift nobody likes talking about. So for decades, foreign countries were the backbone of US debt demand. China, Japan, oil exporting nations, global reserve managers. But the data shows a clear trend. Foreign demand is weakening. And China has been a net seller of US Treasuries. This isn't political commentary. It's Treasury International Capital TIC data. China needs liquidity at home, is managing internal economic stress, and is diversifying reserves away from dollar assets. And whether you agree with the strategy or not, the result is the same. China is not the buyer it once was. And next comes Japan. So Japan is the largest foreign holder of US debt. But Japan now has rising domestic yields, currency pressure, and incentives to repatriate capital. When Japanese yield rise, holding US Treasuries becomes less attractive and money starts flowing back home. So this is not theoretical, this is exactly what global capital does when yield differentials change. And next, the big picture. Across the board, foreign ownership of US Treasuries as a percentage of total debt has been declining. So that doesn't mean foreigners disappear entirely. It means the burden shift inward. If not foreigners, then who? So this is where the question becomes unavoidable. If foreign buyers step back, who replaces them? And there are only a few candidates. First, domestic investors, pension funds, insurance companies, banks. But these institutions already hold massive amount of treasuries and have duration and risk constraints, are sensitive to mark-to-market losses. At higher yield, demand doesn't automatically scale infinitely. And second comes household. Retail investors buy treasuries, but not at trillion-dollar scale. Households do not finance government, institutions do. And third one, the Federal Reserve. And this is where things get uncomfortable. The Fed quite returned as a buyer. Officially, the Federal Reserve says it is not doing quantitative easing. Technically, they say current treasury purchases are temporary short term for market functioning, but step back and look at what's actually happening. The Fed shrunk its balance sheet from $9 trillion to $6.5 trillion and tried to continue quantitative tightening and hit liquidity stress in the system. So they quietly resumed buying treasuries. And you can debate definitions, but economically, when a central bank expands its balance sheet to absorb government debt, the effect is the same, and it is monetary intervention. And here's the key point you can't ignore. The Fed is being asked to step in from a much higher starting point than ever before. In 2008, the Fed balance sheet was under $1 trillion, and today, even after tightening, it's around $6.5 trillion. That changes the scale of everything. And there's another, the interest rate trap. If the Fed does not step in, treasury yields rise, debt servicing costs explode, and market destabilize. So if the Fed does step in, balance sheet expands, monetary base grows, and currency purchasing power erodes. So there is no painless option right here. This is why economists call it a policy trap, and you can choose financial instability now or monetary debasement over time. So historically, government choose the second option, not because they want to, but because it's politically survivable. But bond volatility is low. So this is one of the most misleading talking points right now. Yes, bond volatility measures are low, but low volatility does not equal low risk. In many cases, it means heavy intervention, suppressed price discovery, artificial calm. Markets can look stable right before they reprice violently, and stability created by intervention is not organic stability, it's managed. And every major currency crisis follows a familiar sequence. First, rising debt. Second, higher refinancing needs. Third, central bank intervention. And fourth, currency devaluation and loss of purchasing power. And this doesn't mean hyperinflation tomorrow. It does not mean collapse next month. It means long-term erosion, the kind of don't notice day to day but feel over years. So what this means for savings and purchasing power. So even if account balance stays the same numerically, their real value can decline. And over the past several years, the dollar has lost significant purchasing power. And official inflation understates lived experience. Assets that preserve scarcity outperform paper claims. And this is why central banks buy gold, institutions diversify reserves, and long-term investors focus on real assets, not on speculation but on protection. So my conclusion after seeing the data and after reviewing Fed balance sheet behavior, treasury maturity schedules, foreign ownership trend, my conclusion is simple. The US does not face an immediate collapse, But it does face a structural financing challenge, and that challenge makes higher intervention, larger balance sheet, and continued currency dilution, and far more likely than most headlines admit. The $11 trillion question is not if it gets financed, it's how, and every method has consequences. So I'm not here to tell you what to buy, I'm not here to scare you. I'm here to say this. When you understand the mechanics, the narrative changes. And when the narrative changes, you can plan instead of react. So because history doesn't repeat exactly, but financially it rhymes.